Have you ever seen a trader like this? He can draw Fibonacci retracement levels with precision, recite the Fibonacci sequence by heart, and even claim to anticipate institutional moves through volume analysis. Yet his account balance looks like a roller coaster, making money fast and losing it even faster. What's even stranger is that some beginners who can't even tell MICT from KDJ sometimes end up making money in the market. This isn't superstition. It's one of the harshest truths in trading. Technical analysis is like a flashlight. It can illuminate the road in front of you, but it won't stop you from falling into the holes you dig yourself. The author of this book, Mark Douglas, is exactly that financial surgeon who dissects the trader's mind with a scalpel. Over 30 years, he trained thousands of traders and witnessed countless cases of people with superb technical skills losing everything. The core insight he revealed in Trading in the Zone still shakes the global trading community today. Consistent profitability comes from building a mental structure that resonates with market uncertainty, not from mastering more indicators. The book is long ranked at the top of Amazon's trading psychology category. It's listed as required reading by top institutions such as Bridgewater and Goldman Sachs, and is widely regarded by retail traders as a guide to breaking the cycle of losses. Imagine this scene. You're staring at a candlestick chart and spot a morning star pattern. MAC shows a bullish crossover. Volume is expanding, and every signal lines up perfectly with what the textbook says is a buy. You enter the trade with excitement, only to see the price spike and reverse the same day, then gap down the next morning and blow through your stop loss. You're completely confused. All the technical signals were right, so why did you still lose money? Douglas points out with brutal clarity that technical analysis is essentially an attempt to project the future using historical data. While the market itself is a dynamic system driven by the emotions and actions of millions of participants, it's like knowing that 80% of drivers will brake at a red light, yet never being able to predict whether a drunk driver will run straight through it. Indicators can help you identify recurring behavior patterns, but they can't tell you the probability that a pattern will work this time, or can they control the fear you feel when a trade goes against you. Douglas's research exposes a hard reality. Traders' psychological state determines whether technical signals can be turned into effective action. In his trader training programs in Chicago, he repeatedly found that consistently profitable traders shared three key traits. First, they were emotionally indifferent to losses. They treated stop losses as the cost of doing business, as naturally as a casino pays for electricity and water. Second, they embraced probabilistic thinking, understanding that individual trades are random, but that sticking to a high probability edge over time inevitably leads to positive results. Third, they practiced emotional separation, refusing to let the outcome of one trade influence the next decision, much like professional poker players who don't tilt after losing a hand. By contrast, most retail traders fall into two major psychological traps. The first is the illusion of control, believing they can predict the market and treating technical analysis as a guaranteed winning formula. The second is loss aversion. The pain of a loss feels about 2.5 times stronger than the pleasure of an equivalent gain, a conclusion backed by Nobel Prize-winning research by Daniel Kahneman. Together, these biases cause traders to hesitate when they should cut losses and panic when they should hold. The greatest value of this book for ordinary traders is that it shatters the myth of technical worship. It reminds us that trading is not a math exam. Getting the answers right doesn't guarantee a high score. Driving a car is a good analogy. You need to know where the brake and gas pedals are, but staying mentally clear is far more important. The belief restructuring exercises in the book help you shift from being a predictor to becoming a probability player, accepting the uncertainty of every trade and focusing on executing strategies where you truly have an edge. Once you grasp how crucial psychology really is, a deeper question naturally follows. What is the true nature of trading, and why can't technical analysis guarantee success? In the next section, we'll explore the cognitive shift from analyzing the market to analyzing yourself, and how that transition allows you to finally understand what the market really is. As Douglas wrote, the market is a mirror. It reflects not candlestick charts, but your deepest fears and desires. Only when you learn to make peace with yourself can you survive and ultimately win this profoundly anti-human game. We often assume that the key to making money in trading is seeing through the market. either by calculating the balance of supply and demand in fundamentals, or by discovering a can't-lose pattern hidden in technical charts. But in his work on trading psychology, Mark Douglas tears open a brutal truth. Whether it's fundamental analysis or technical analysis, they are only tools. What truly determines whether you win or lose is how you use those tools, and that ultimately comes down to your mindset. First, fundamental analysis looks scientific, but it ignores the human factor. When most beginners enter the market, they dive headfirst into fundamentals, study financial statements, macroeconomic data, and supply-demand models, believing that if they can calculate where the price should be, consistent profits will follow. But Douglas tells us this thinking is flawed at its root. The core logic of fundamental analysis is to use mathematical models to combine variables like interest rates, balance sheets, and even weather in order to predict where prices should go. It sounds scientific, right? But it has a fatal flaw. It doesn't treat other traders as variables. Prices are not determined by models. They are pushed up and down by the collective buying and selling decisions of countless traders. If most market participants don't know your model, or simply don't believe in it, then even the most elegant model is useless. More importantly, emotion cannot be calculated. Douglas witnessed countless cases where fundamentals clearly suggested a commodity should rise, yet the market collapsed due to sudden panic. Traders who stubbornly stuck to their models could only watch their positions bleed. Even if your prediction eventually turns out to be right, the violent price swings along the way may break you long before that. It's like knowing there's treasure in the distance, but getting knocked over by storms long before you ever reach it. In plain terms, fundamental analysis is like using a telescope to look at a distant mountain peak. It can tell you where the summit is, but it cannot tell you how many cliffs, fog banks, and dead ends lie along the path. Second, technical analysis can reveal opportunities, but it cannot stop your psychological collapse. After realizing that fundamental analysis isn't reliable, many traders turn to technical analysis, drawing trend lines, identifying support and resistance, watching MACD crossovers. The logic is seductive. Traders tend to repeat past behaviors, forming observable patterns. And if you can capture those patterns, you can make money. Douglas does not deny the value of technical analysis. Compared to fundamentals, it is far more grounded. It doesn't try to predict how the market should behave. It observes how the market is behaving and looks for statistical edges in historical data. For example, if you discover that after breaking above the 20-day moving average, a stock continues higher 70% of the time, that's a technical edge. But here's the problem. Knowing that a pattern exists and actually making money from it are two very different things. Douglas gives a painfully familiar example. Many traders stare at the chart, clearly seeing that the market is about to move higher, yet they freeze and watch the opportunity slip away. Afterwards, they slap their thigh and say, "I knew it." Why? Because in that moment, fear takes over. Fear of being wrong, fear of losing capital, fear that this time is different. Technical analysis can help you see the opportunity, but your psychological resistance can block your ability to act. It's like holding a perfectly good gun, but your hands are shaking so badly that you can't hit the target. So why must we turn inward and analyze ourselves? Because trading, at its core, is a battle with oneself. When neither fundamental analysis nor technical analysis can guarantee profits, we are forced to confront a simple fact. In trading, your real opponent is not the market, but you. Drawing on 17 years of experience as a trading coach, Douglas repeatedly proved that the difference between elite traders and ordinary ones is not analytical skill, but mindset. He saw countless technical experts fail. Some could accurately identify trends, yet panic and exit during normal pullbacks. Others built systems with an 80% win rate, but after 2 consecutive losses, they lost faith and stopped following the system altogether. None of these problems are technical. They're psychological knots. And what are those knots? Fear of risk, an obsession with being right, an inability to accept losses. Have you ever felt that after a losing trade, the market was somehow targeting you? In reality, the market doesn't even know you exist. It simply moves according to the collective behavior of all participants. It is your mindset that interprets a normal loss as a personal attack, triggering anger, hesitation, or even revenge trading. Douglas once compared consistent winners and average traders to the Earth, the Moon. They exist in the same trading solar system, but their nature is fundamentally different. Winners are able to embrace risk. They accept that every trade can lose, so fear doesn't stop them from acting. They trust long-term probabilities, so a single win or loss doesn't throw them off balance. Ordinary traders, on the other hand, are constantly torn between wanting to win and fearing loss. And in that struggle, they waste the very edge that technical analysis gives them. The path to trading mastery is essentially a reversal in thinking. Beginners believe, I can understand the market, so they obsess over analysis. Experts understand I cannot control the market, but I can control myself, so they focus on mindset. Fundamental analysis tells you what the market might do. Technical analysis tells you what the market is doing. But only psychological analysis tells you how you should respond. As Douglas said, the market itself is neutral. It simply offers opportunities. Your mindset is what labels those opportunities as good or bad, and that label determines whether you can seize them. And when you finally realize that analyzing yourself matters more than analyzing the market, you'll see that what has been draining your account was never complex charts or incomprehensible financial statements, but the psychological traps inside your own mind, refusing to set rules, avoiding responsibility, and becoming addicted to random wins. These are exactly the psychological blind spots we will break down in the next part. When Mark Douglas coached traders, he discovered a painfully revealing pattern. Most people don't lose money because they lack technical skill. They lose money because they fall into psychological traps of their own making. These traps are hidden inside our habitual ways of thinking. They look harmless on the surface, but at critical moments they quietly push you straight toward losses. Almost every trader, without exception, has fallen into the following 4 traps. Trap 1. Refusing to set rules and turning freedom into disaster. What is the most attractive thing about trading? Freedom. No boss watching you. No fixed process. You can enter a trade whenever you want and exit whenever you feel like it. It feels as if the entire market is under your control. But Douglas warned that this kind of unchecked freedom is exactly where losses are born. Why? Because from the time we are young, we grow up surrounded by rules. Parents tell us what not to touch. Teachers tell us what must be done. Society tells us to follow order. After years of being constrained, we naturally develop a resistance to limits. So once we step into trading, a space with almost no external rules, we instinctively reject setting rules for ourselves. We say we will cut losses and close positions, but when it comes to execution, excuses appear instantly. This situation is special. I don't need a stop loss. The trend is so strong, adding a bit more won't hurt. Douglas saw countless examples like this. Some traders place trades purely on intuition. When they make money, they credit talent. When they lose, they blame bad luck. Others learn dozens of indicators, yet never establish fixed entry or exit rules, choosing indicators based on mood alone. The result? They never know how their money was made, and they never understand how it was lost. It's like wandering blindly through a maze, occasionally finding the exit, only to return to the starting point again and again. So the truth is, freedom in trading must be protected by self-imposed limits. Just like wearing a seatbelt while driving or obeying traffic lights when crossing the street. These rules are not there to restrict you, but to keep you alive. Refusing to set principles may look like freedom, but in reality, it exposes you to unlimited risk. When the market suddenly turns, you have no protection at all. Trap 2. Avoiding responsibility, blaming the market for losses and taking credit for wins. This market is rigged. Someone must be manipulating prices. If I hadn't listened to my broker yesterday, I wouldn't have lost. Sound familiar? Douglas pointed out that behind these statements lies a deadly psychological trap: the refusal to take responsibility for trading outcomes. Traders often do something deeply contradictory. When they make money, they believe it's because their analysis was brilliant and their judgment precise. When they lose money, they shift the blame to the market, the news, bad luck, or so-called insiders. At its core, this mindset wants the rewards of trading without accepting its risks. A simple way to tell if you've fallen into this trap is to look at how often you trade outside your plan. You plan to trade stock A? but a friend mentions stock B might rise and you immediately switch positions. You set a stop loss, but cancel it because you believe the price might bounce back. Douglas described a classic case in his book. A trader spent an entire week analyzing the market and building a detailed plan. At the opening bell, he heard a so-called insider tip from his broker and abandoned the plan to chase another stock. The result was a massive loss. On the surface, he was taking advice. In reality, he was escaping responsibility. If it failed, it wouldn't be his fault. But the market is brutally fair. It never takes responsibility for anyone, no matter how many excuses you make. The numbers in your account never lie. Douglas emphasized that real traders treat every gain and every loss as the result of their own decisions. Only when you admit this outcome happened because of my choice can you actually learn from mistakes. Otherwise, you remain trapped in an endless cycle of blaming others. Trap 3. Addiction to random rewards. The thrill of quick money destroys discipline. Have you ever experienced this? You buy a stock casually with no expectations and it suddenly surges. Or you place a trade based on pure feeling and somehow make a lot of money. That rush of unexpected profit is a dangerous drug. Douglas called this addiction to random rewards. He described an experiment where scientists trained monkeys to complete tasks and rewarded them each time. The monkeys quickly learned that effort equals reward. But when rewards were given randomly, sometimes yes, sometimes no, the monkeys became even more persistent. Even after long periods with no reward, they kept going, convinced the next attempt might bring a surprise. Traders behave the same way. A few lucky profits made by pure chance can hook someone on the thrill of winning by luck. They stop studying strategies and abandon discipline. It's like someone winning a few rounds of mahjong and suddenly believing they are a gambling god. Staying at the table until everything is lost. Douglas witnessed extreme cases. One trader made large profits 3 times in a row purely on intuition. From that moment on, he completely abandoned analysis and chased every move. Within 6 months, he had not only lost all his previous profits, but ended up in debt. The danger of this addiction is that it turns randomness into certainty in your mind. You begin to believe you can win without rules. Patience and discipline slowly disappear. And when the market finally shows its brutal side, you are left defenseless. Trap 4. Trying to control the market when the only thing you can control is yourself. I've analyzed this so thoroughly. How can the market not go up? As long as I watch the screen, I can avoid the drop. This illusion of control is one of the most common traps in trading. Douglas saw even top professionals at the Chicago exchanges fall into it. In one case, a technical analyst precisely identified support and resistance levels and confidently declared that soybean prices would rebound from support. At that exact moment, a large trader dumped roughly 2 million bushels of soybeans, about 54,000 metric tons, into the market. The price crashed straight through support, and the analyst was stunned. This perfectly illustrates one of Douglas's key ideas. In the market, it only takes one trader acting in the opposite direction to turn your certainty into pure chance. In everyday life, effort often leads to results. Work hard, and you may get promoted. Treat people well, and you may be treated kindly. But the market is different. It has no emotions. It won't spare you because your analysis was thorough, and it won't pity you because you lost money. Douglas said the market is like a river. You can flow with it, but you can never force it to flow your way. Many traders waste their energy trying to predict and control the market while forgetting the only things they truly control: position size, stop-loss rules, and mindset. Like rowing a boat, you cannot change the wind, but you can adjust the oars. That is real control. All these traps share the same root: the human instinct to avoid risk. Refusing rules, avoiding responsibility, chasing random rewards, and trying to control the market are all expressions of the same fear: the refusal to face uncertainty. Trading is inherently uncertain. Losses are an unavoidable part of the game, yet our brains constantly look for excuses to escape this reality. That precisely is the core of what comes next. To truly escape these traps, you must first learn to fully accept risk. Not just saying, "I know there's risk," but deeply accepting that every single trade can lose, without resentment. Only then can you stay clear-headed through market swings and allow your strategy and skills to work. As Douglas said, okay, traders' growth begins the moment they stop fighting the market and start making peace with themselves. Many traders will say, of course I know trading involves risk. That's obvious. But in Trading in the Zone, Mark Douglas makes a sharp distinction. Knowing that risk exists and truly accepting risk are two completely different things. It's like driving a car. You know, accidents can happen, but only when you genuinely accept that, even if you're careful. Accidents are still possible. Do you fasten your seatbelt and buy insurance? That mental shift is where consistent profitability in trading actually begins. So what does it really mean to fully accept risk? It doesn't mean surrendering or giving up the desire to make money. It means learning to coexist with risk. To fully accept risk is to acknowledge deep down a simple fact: any trade can lose money. And that loss has nothing to do with how smart you are or how hard you worked on your analysis. It's simply a natural part of trading itself. Just like running a restaurant requires paying rent. Or running a business requires holding inventory. Losses are the operating cost of trading. They are a price you must be willing to pay, calmly and without resentment. Douglas gives a powerful example in the book. Consistent winners treat losses the same way ordinary people treat paying for meals. It's normal. They don't get angry, blame themselves, or question their ability because of a losing trade. They understand that it's not a personal failure. It's simply a normal outcome within a probability distribution. Most traders, however, interpret losses very differently. They see a loss as proof that something is wrong with them. Some react by angrily adding 2 positions to get revenge on the market. Others become so frightened that they stop trading altogether. Both reactions are clear signs that risk has not been fully accepted. True risk acceptance operates on 3 levels. First, the cognitive level. You must clearly understand that there is no such thing as a 100% certain trade. No matter how perfect the technical setup looks, an unexpected event like a large trader suddenly taking the opposite side can still lead to a loss. Second, the emotional level. When a loss occurs, you remain emotionally neutral. You don't regret what could have been, and you don't become anxious about what might happen next. Third, the behavioral level. You prepare for losses in advance. You set your stop loss before entering the trade, and when it's hit, you execute it without hesitation. Because you know this isn't surrendering, it's simply following the rules of the game. What happens if you don't fully accept risk? Based on 17 years of observation, Douglas found that almost every trading mistake can be traced back to resistance toward risk. Maybe you've seen a perfect entry signal, but hesitated because you were afraid of losing. The market took off without you, and afterward you could only regret it. Or maybe a trade reached your stop level, but you kept telling yourself to wait, convinced it would bounce back, only to watch the loss grow larger. That's not analysis. That's refusing to accept that a loss has already occurred. There's also a more subtle effect, the fear of missing out. When you can't accept that missing opportunities is normal, you end up chasing prices after the move has already started. Even when you know the risk is high, the fear of making less pushes you into impulsive trades. Douglas called this double fear, the fear of losing and the fear of missing out. Caught between these 2 emotions, traders often make their worst decisions. He cited a brutal statistic. 95% of trading errors come from 4 fears: fear of being wrong, fear of losing money, fear of missing opportunities, and fear of being inferior to others. At their core, all of these fears stem from the same problem: the refusal to accept risk. You try to eliminate risk through analysis, prediction, or even hope. But market uncertainty is an objective reality. The more you resist it, the harsher the lesson tends to be. Why? So how do we cultivate a mindset that truly accepts risk? The answer is to shift from resisting risk to embracing it. Accepting risk sounds simple, but it's deeply challenging because it goes against our natural instinct to avoid pain and seek certainty. Douglas offered 3 practical methods to help traders gradually build this mindset. First, treat your stop loss as an entry fee. Most people see stop losses as symbols of failure. Winners see them as the price of participation. Just like buying a movie ticket, you don't get angry if the movie isn't great, because the ticket simply gave you access. In the same way, a stop loss is the cost of entering the market. Douglas advised traders to calculate this ticket price before every trade, the maximum loss they can comfortably accept, and then pay it willingly. Second, replace right or wrong thinking with probability thinking. Losing traders obsess over whether a trade is right or wrong. Winning traders focus on whether a strategy has a positive edge over time. If a strategy wins 60 out of 100 trades and loses 40 but produces a net profit, that's enough. You don't need to win every trade, just like a casino doesn't need to win every hand. It only needs the odds on its side. Douglas emphasized that accepting risk means accepting randomness in individual trades while trusting consistency over the long run. Third, deliberately expose yourself to risk. Psychological desensitization works like learning to swim. You have to get into the water. Douglas recommended that beginners start with losses they can easily afford and intentionally experience planned losses. Set small stop losses and allow several trades to hit them. When you realize that nothing catastrophic happened, the world didn't collapse, and your account survived, you begin to understand that losses are manageable. This breaks the mental link between loss and disaster. Accepting risk is the foundation of consistency. When you truly accept risk, something remarkable happens. The market stops feeling threatening. You no longer react emotionally to every price fluctuation or every outside opinion. You understand that volatility is normal, and your only job is to execute your strategy. Douglas said that the best traders aren't consistently profitable because of superior technical skill. They succeed because their minds no longer associate risk with danger. They see only probabilities and opportunities, not fear or hope. That mindset is where true consistency begins. And once risk no longer casts a shadow over your decisions, you can focus entirely on execution, allowing profits to emerge naturally. How to turn this acceptance of risk into consistent behavior is the next core topic, building a mindset of consistency. It's not a talent you're born with, but a trainable way of thinking. And it's the line that ultimately separates winners from losers. Many traders fall into a common trap. They believe that if they can just find the perfect technical system, consistent profitability will naturally follow. But in Trading in the Zone, Mark Douglas shatters this illusion with a single idea. The difference between consistently profitable traders and everyone else is not the tools they use, but how they think about using those tools. Consistent profitability is not a technical problem. It's a mental state that allows you to stay disciplined, focused, and confident in the face of uncertainty, and to keep executing your strategy even through a string of losses. So what does consistency actually mean? It doesn't mean never losing. It means your equity curve rises steadily over time, your drawdowns stay within control, and your decision-making process remains the same from one trade to the next. Douglas said the core of this state is the absence of internal conflict. You're not hesitating out of fear, you're not overreaching out of greed, and you're not letting past wins or losses distort your current judgment. He gave a simple example. Skilled traders don't obsess over whether the next trade will be wrong when they enter, because they've already accepted that being wrong is normal. They don't hesitate to exit just because they might make a little more money, because they trust that following rules matters more than squeezing extra profit from a single trade. This lack of internal conflict makes their behavior almost mechanical. They enter when they're supposed to enter, they stop out when they're supposed to stop out, and they follow the system without negotiation. Average traders, on the other hand, are constantly fighting themselves. When a signal appears, one part of them says, "This is the opportunity," while another part whispers, "What if it loses?" and the moment passes. When they're in profit, they want to lock it in, but they also hope for just a bit more. And in the end, they either take tiny profits or ride the trade all the way back down. When they're losing, they know they should exit, but they keep telling themselves it will bounce back until the loss becomes unavoidable. Douglas emphasized that internal conflict is the greatest enemy of consistency. The more tangled your thinking becomes, the more chaotic your behavior gets, no matter how good your technical system is. Hesitation and impulsiveness will eventually destroy it. So why can't technique solve the consistency problem? Because your mindset distorts the way you apply technique. Many traders spend years studying indicators, from moving averages to Elliott wave theory, from price volume analysis to algorithmic models. Yet they remain stuck in the same cycle of winning and losing. The issue isn't the tools, it's the mindset twisting how those tools are used. Douglas described a classic scenario. Trader learns a strategy with a 70% win rate that performs well in backtesting, yet loses money in live trading. Why? Because in real trading, he starts executing selectively. After 2 wins, he feels invincible and increases position size. After 2 losses, he doubts the system and stops following it altogether. The strategy didn't fail, his mindset distorted it. An even subtler distortion comes from biased interpretation. When you look at the market through fear, every pullback feels like the beginning of a crash, and you exit what is actually a normal fluctuation. When you look at the market through greed, every small bounce feels like the start of a massive move, and you chase trades with no real signal. Douglas said the market itself is neutral. It's your mindset that labels it as good or bad. Technical analysis can tell you what the market is doing, but your mindset determines how you interpret that information. That's why the same system produces wildly different results in different hands. Technique is the tool, but mindset is the hand holding it. If the hand isn't steady, even the best tool won't work. So what's different about the mindset of consistent winners? The answer can be summed up in 3 words. They are not afraid. After observing thousands of traders, Douglas found that all consistent winners share this trait. But this lack of fear is not recklessness. It's built on complete acceptance of risk. They understand that trading is risky, but they also understand that fearing risk makes them even more vulnerable. This mindset has 3 clear characteristics. First, they are desensitized to losses. They don't see losses as failure, but as a cost of doing business, just like shrinkage in a retail store. They accept that out of every 10 trades, 3 or 4 may lose and a single loss doesn't shake them. Second, they remain emotionally neutral toward profits. After a string of wins, they don't feel brilliant, and they don't suddenly bet bigger. Douglas saw countless traders make quick money, become overconfident, and then give it all back in one loss. Winners understand that profits come from the system, not from personal genius. Third, they submit to the market. They don't try to predict what the market should do. They observe what it is doing and align with it. Like a surfer who doesn't fight the wave but adjusts to its direction. This submission isn't passive, it's respect for uncertainty. This mindset sounds deeply counterintuitive, but Douglas said it can be trained. The most important step is breaking the belief that trading means you must always be right and fully accepting that trading is a probability game. Your job isn't to win every time, it's to stay on the favorable side of probability over the long run. So how do you build this mindset? Not by fighting yourself, but by accepting yourself and cultivating consistency step by step. This doesn't mean becoming an emotionless machine. It means learning to coexist with your emotions without letting them take control. Douglas outlined 3 core training methods. First, replace outcome focus with process focus. Stop asking whether this trade will make money and start asking whether you followed your rules. If your system says to enter on a breakout above the 20-day moving average and exit below the 10-day moving average, then executing that process correctly makes the trade a success, regardless of profit or loss. Douglas said consistency comes from commitment to process, not obsession with outcomes. When you focus on process, emotions naturally settle. Second, allow room for emotional fluctuation. Don't expect yourself to be perfectly calm at all times. Feeling tension or hesitation is normal. What matters is recognizing when emotion is influencing you and bringing your attention back to logic. If you notice you're afraid to enter a valid setup, don't blame yourself. Simply remind yourself that the signal is valid, the risk is defined, and it's time to act. Third, build confidence through small wins. Consistency is built on confidence, but confidence doesn't come from hitting big trades. It comes from repeatedly doing the right thing. Douglas recommended starting with small position sizes and executing flawlessly. Even small profits count as long as the process is correct. Over time, these small wins build the belief that you control your behavior, not the market. At its core, a consistent mindset is a product of belief. If you believe trading is a probability game, you can accept losses. If you believe discipline leads to profitability, you resist impulsive behavior. If you believe you control your actions, emotions lose their power over you. These beliefs aren't innate, and they don't come automatically from learning technical analysis. They must be deliberately cultivated, and often they require confronting and replacing old beliefs that sabotage performance. That's why the next section dives into the power of belief itself, how to replace destructive mental patterns with beliefs that support consistent profitability. As Douglas put it, the true evolution of a trader is an upgrade of the belief system. What you believe ultimately determines what you become. Mark Douglas discovered a striking pattern in his research. Traders' profits and losses are often a direct projection of their inner beliefs. If you believe the market is dangerous, you'll see traps everywhere. If you believe trading's about luck, you'll become addicted to random wins. And if you truly believe you can be consistently profitable, you'll eventually find a way to make that belief real. Beliefs work like mental software. They determine how you interpret the market, how you design your strategies, how you execute trades, and ultimately, what results you get. So what exactly is a belief? It's an invisible commander operating deep inside your mind. In Douglas's view, a belief is organized energy. It's formed by your past experiences, learned concepts, and emotional memories woven together into a personal rulebook for interpreting the world. For example, someone who was bitten by a dog as a child often forms the belief that dogs are dangerous. And from that point on, fear becomes an automatic response. What makes beliefs so powerful and so dangerous is that they automatically filter information. In the same way, a trader who has suffered repeated losses may form the belief that the market is out to get them, and as a result, they truly do struggle everywhere they turn. They block out anything that contradicts them and highlight only what confirms them. Douglas once shared a classic example. On Michigan Avenue, someone stood holding a sign that said free money, yet almost no one took it. Not because the money wasn't real, but because the deeply ingrained belief that there's no such thing as a free lunch caused people to label the man as a fraud or a lunatic, automatically dismissing the possibility that the money was real. The same thing happens in trading. If you believe you must predict the market to make money, you'll obsess over complex indicators and ignore simple trend signals. If you believe that stopping out means admitting failure, you'll let losses grow until you're forced to exit. Your beliefs ultimately allow you to see only what you want to see while missing what truly matters. Now let's look at the beliefs that quietly drain traders' accounts. Douglas identified several belief traps that most traders fall into. They sound reasonable on the surface, but over time, they push you straight toward losses. Belief trap number 1: I must know what will happen next, or I can't enter a trade. This is the perfectionist trap. You believe that if you analyze deeply enough, you can predict the next move. But the reality of the market is that anything can happen. Douglas saw countless traders miss great opportunities simply because they couldn't tolerate uncertainty, only to realize later that the traders who made money were the ones who accepted not knowing. Belief trap number 2: there must be a way to never lose money. This obsession with certainty drives traders to chase holy grail systems, switching methods the moment a loss appears. They're always searching and never committing. The truth is that losses are a natural part of trading, just like oxygen is necessary for breathing. Refusing to accept that is like refusing to put gas in your car while expecting it to keep driving forever. Belief trap number 3: the market is against me. After a series of losses or missed opportunities, have you ever felt that the market was targeting you personally? Douglas said this belief comes from an unwillingness to take responsibility. The market is simply the collective behavior of countless participants. It has no emotions and no intent. The hostility you feel is actually your own fear of loss being projected onto the market. Belief trap number 4: when I win, it's because I'm skilled. When I lose, it's just bad luck. This double standard creates blind confidence in profits and denial in losses. As a result, you never truly learn from mistakes, swinging endlessly between arrogance and self-doubt. Now let's flip the perspective and look at the belief system of consistent winners. Douglas found that successful traders tend to hold beliefs that are the exact opposite of the average person's. These beliefs sound simple, but they allow winners to stay stable through volatility. The first belief: anything can happen. This is the foundation of all winning belief systems. They don't obsess over whether the market will go up or down. They accept that both are possible and prepare for both by defining risk and setting exits in advance. The second belief: you don't need to know what will happen next to make money. Just like a casino doesn't need to know the outcome of the next roll of the dice. It only needs a long-term statistical edge. Winners trust that if they execute their strategy consistently, the probabilities will work in their favor over time. So they don't panic about the unknown future. The third belief: wins and losses are randomly distributed. The edge shows up over time. They accept that a string of losses is normal and doesn't invalidate the system. Just like flipping a coin, even after 5 heads in a row, the next flip is still 50-50. This understanding of randomness allows them to survive drawdowns. The fourth belief: an edge means higher probability, not certainty. They don't aim to be right every time. They focus on making more when they're right than they lose when they're wrong. For example, even with a 50% win rate, if you make $3 on winners and lose only $1 on losers, the long-term outcome is profitable. The fifth belief: every moment in the market is unique. They don't assume that because a pattern worked last time, it must work again. Market participants change, emotions change, and past patterns are references, not guarantees. Together, these beliefs eliminate internal conflict. Winners don't fight the market, and they don't fight themselves. They simply focus on doing the right things consistently, allowing profits to emerge naturally. So how can an average trader reshape their belief system? The answer is by rewriting mental software through action. Beliefs aren't innate, and they don't change just because you think differently. Douglas argued that the only way to change a belief is to replace old memories with new experiences. Just like a child who fears dogs can only overcome that fear through repeated positive encounters, in trading, the process works the same way. First, identify the old belief. When you hesitate to take a stop loss, ask yourself whether you're afraid of admitting you're wrong. Second, create new experiences through small actions. For example, define a simple stop-loss rule and execute it consistently for 20 trades. When you see that nothing catastrophic happens after stopping out, your mind begins to accept that stops are safe. Finally, reinforce the new belief through repetition. It's just like athletes train movements until they become muscle memory. You must repeatedly act on new beliefs until they become instinctive. Douglas emphasized that belief change is never a sudden awakening. It's a gradual process. And when you finally break free from the belief that you must always be right and must never lose, you'll realize that what was holding you back was never the complexity of the market, but the hidden belief traps inside your own mind. After breaking down every technical analysis method and every psychological trap in trading, Mark Douglas ultimately reveals a truth that is surprisingly simple. Trading has never been a battle between you and the market. It has always been a battle between you and yourself. Every dollar you make is a reward for your beliefs, your discipline, and your mindset, and every dollar you lose is exposing the hidden traps in your thinking. Whether it's refusing to follow rules, avoiding responsibility, or fearing risk, at its core, trading is the art of learning how to live with yourself. The market is nothing more than a mirror, reflecting the chaos or calm inside you. And the way you interpret the market is really the way you interpret yourself. When you refuse to set rules, you are avoiding the discomfort of self-discipline. When you can't accept a loss, you are afraid of admitting that you might be wrong. When you get addicted to random profits, you are relying on luck and the illusion of getting something for nothing. None of these are problems created by the market. They exist because you haven't yet made peace with your own weaknesses. Every real trader eventually understands this. Technical analysis can teach you how to read trends, but it cannot teach you how to enter a trade without hesitation when the moment comes. Position sizing and risk management can tell you how big your trades should be, but they cannot stop you from impulsively adding to a position out of hope. The traders who achieve true consistency are not winning because of complex candlestick patterns or sophisticated indicators. They win because they have learned to control themselves. They define rules in advance and follow them strictly. They accept losses as naturally as changes in the weather. And they trust long-term probability instead of obsessing over the outcome of a single trade. As Douglas said, the market doesn't care what you think, and it certainly doesn't sympathize with your losses. It simply moves according to the collective behavior of all participants. The only thing you can do is adapt your thinking and your actions to its rhythm. This adaptation is not surrender. It is wisdom. It means knowing your limits, accepting your imperfections, and allowing profits to become a natural byproduct of doing the right things consistently. So the next time you stare at flashing candlesticks on your screen, pause for a moment and ask yourself, what am I afraid of right now? What am I hoping for? Have I fallen into another psychological trap of my own making? Answering these questions is often far more important than understanding any complex indicator. Because the final destination of trading has never been about beating the market. It has always been about learning how to truly live with yourself. And with that, congratulations on finishing another book.